Welcome back to the Deep Dive, the shortcut you need to understand not just what's happening in the global economy, but really why.
Yeah.
Today, we are deep diving into a topic that, okay, it sounds like dry financial policy, but honestly, it's about the future of human freedom. We're talking about the inevitable shift to digital currency. And look, this conversation isn't really about Bitcoin, and it's definitely not just about faster payment apps on your phone.
Yeah, not at all.
It's about who gets to issue money, who gets to control it, and crucially, whether your transactions will ever remain private again.
That's really the core tension we're exploring today. For you, the listener, our mission here is, I think, pretty critical. We're going far beyond the usual kind of superficial discussion of central bank digital currencies, CBDCs.
Right.
We are dissecting a radical alternative proposal. It's called electronic public money, or EPM, and its even more radical companion, which is a fundamental overhaul of taxation called the Uniform Tax System, or UTS. We really need to understand exactly why the structural plumbing of our current debt money system, why it must be replaced if we want to retain any kind of personal and economic sovereignty in a fully digitized world.
And our sources for this, they provide an astonishingly detailed blueprint for this kind of overhaul. They contrast the existing debt money model where, banks create something like 99% of our currency at interest, arguing it's just inherently unstable.
Which it is.
Yeah, and then they juxtapose the, let's be honest, the privacy-eroding nature of CBDC against this robust privacy by default design of EPM, and they connect that financial reform directly to the ultimate tax simplification via this UTS.
It's all linked.
Okay, let's unpack this.
Right. So to really appreciate the revolution proposed by EPM, we first have to truly understand what money actually is and how it became what it is today.
Yep.
At its most basic level, money is just information about value. And it needs a medium, right? Something to register ownership and facilitate exchange.
Makes sense.
Our sources provide a really useful classification by medium, and it kind of illustrates how far we've traveled.
Right. We started with, non-metal commodities,
Yeah.
shells, cattle, cloth, that sort of thing.
Exactly. Then moved through metallic forms.
Yeah.
You had the Lydian electrum coins, Roman gold, eventually the gold standard.
And from there, we jumped into paper and polymer, which is, the realm of traditional central bank notes that we still sort of use.
We do, but the age we live in now is fundamentally dominated by electromagnetic deposits. That's the digital ledger entries you see on your bank screen. And it's also the central bank reserves used for interbank settlement. That's the bulk of it.
Okay, so the shift to digital representation is profound, obviously. Yeah. But you're saying the structural flaw in our modern system actually predates all this digital stuff.
Oh, absolutely. It stems from an invention that really accelerated commerce way back in the 14th century. Double entry bookkeeping.
Okay. Accounting.
Yeah, simple accounting.
Yeah.
But this innovation laid the groundwork for modern banking as we know it.
And crucially, the innovation of fractional reserve banking. Can you just maybe tell us simply what that process actually entails? Because you said this is the engine that drives instability.
Yeah, fractional reserve banking is it's the main mechanism through which commercial banks create most of the money we actually use. Historically, banks were just supposed to be custodians of physical assets like gold.
Right, they just held it for you.
Exactly. But they soon realized they could use those deposited funds to make interest-bearing loans. So if a bank receives a deposit of, say, $100, they're only required by regulation to keep a fraction, let's say 10%, just $10, and they can lend out the remaining $90.
Okay.
And crucially, when they issue that $90 loan, they don't give the borrower physical cash from the vault. They just create a new demand deposit of $90 on their ledger in the borrower's name.
Wow. So wait, the original $100 still exists in the first account, and now there's a brand new $90 floating around in the second account, meaning the money supply just expanded to $190 based on that initial $100 deposit.
Besides,
The bank essentially created new purchasing power, new money, out of nothing, simply by extending a line of credit.
exactly, that's the key. And this new money is issued as debt at interest.
Right.
The establishment of the Bank of England back in 1694 really formalized this practice.
Right.
This moved central institutions from being just custodians to being active creators of credit. Now, this system was initially constrained somewhat by the gold standard.
Yeah, you had to have some gold backing it.
We did. But we finally transitioned to a pure fiat system, meaning money backed by nothing but government decree, after the U.S. suspended the dollar's convertibility to gold in 1971. Nixon shock.
And the staggering consequence today, which you mentioned earlier, is that 99% of our money stock, the money circulating in your daily life, the money you use, is debt money created by commercial banks and central banks and issued at interest.
And this is the core structural instability our sources really hammer home. Because all this new money is created as interest-bearing debt, the total amount of debt in the system, that's the principal plus the interest owed, must always mathematically exceed the existing money supply needed to pay it back.
Wait, run that by me again. The debt is always bigger than the money available to pay it.
Always. Which means the economy requires continuous exponential growth, and crucially, the continuous creation of new debt, just to find the money needed to service the interest on all the existing debt principal.
That sounds like a treadmill.
It is. And if debt creation slows down or stops, the system contracts violently. That's the fundamental mechanism behind the perpetual boom-bust cycle we see. And it's why governments are locked into these massive, ever-growing taxation requirements. They need the tax revenue just to fund their own debt service payments.
That context is absolutely vital. Okay, so we're living in this digital debt-ridden environment. And then came the biggest challenge to fiat currency, digital tokens.
Yeah, right? In 2008, perfectly timed, coinciding with the massive financial crisis caused by the very instability we just described.
Right.
Satoshi Nakamoto published the white paper for Bitcoin, and it was revolutionary, no question. It created a system where transactions are recorded on a digital ledger, a blockchain, generated without relying on any single trusted entity like a bank.
Decentralized.
Exactly. And it mathematically prevented the dreaded double spending problem, which was the big hurdle for digital cash before.
It was definitely hailed as the non-governmental alternative. But our source material here is, well, quite sober in its assessment of Bitcoin. Why do they conclude that it's not really functional money or legal tender?
Well, it really boils down to function and stability. While Bitcoin's underlying technology is revolutionary, its primary use case has become overwhelmingly speculative. It's an asset people trade.
Right, not something you buy coffee with generally.
Generally not. And legally, you cannot compel acceptance of Bitcoin for payment of a debt, so it fails the legal tender test. Plus, it is inherently volatile, lacking intrinsic value, which leads to these massive boom-bust cycles we saw in, 2013, 2017, 2021?
Yeah, those are wild.
But the ultimate defect, according to these sources, is structural. Even if, hypothetically, Bitcoin became widely accepted as base money, if private banks were then allowed to use it for fractional reserve banking.
Okay.
It would simply transfer the same structural instability of the fiat system onto the crypto base. It doesn't solve the core problem of debt-based money creation. It just changes the underlying base unit.
So it doesn't fix the engine, just changes the fuel, potentially.
Kind of. Yeah.
Okay. So the financial establishment, recognizing both the threat, maybe, of decentralized tokens and the underlying instability of their own system, is now rushing to introduce their own version, central bank digital currency, CBDC.
Exactly. And globally, central banks are really accelerating their plans for retail CBDC. Now, this is a new type of electronic liability designed specifically to be used directly by the general public.
This distinction is really paramount for you, the listener, to grasp. Our existing digital money, those electromagnetic deposits, are mostly limited to interbank settlements and commercial bank accounts. Retail CBDC is intended to be like a digital banknote for your daily transactions, offering payment finality like physical cash does.
And in developing nations, you can actually see some tangible benefits already. Cambodia's Bekong system, for instance, launched back in 2020 on the Hyperledger Iroha blockchain.
Okay.
It's a great example. It successfully reached about 60% of the population, providing real financial inclusion to citizens who were previously outside the formal banking system, and it has successfully encouraged the use of their domestic currency, the riel.
But, okay, the host nations of these discussions, we're talking developed economies like Japan, the EU, the US, they already have highly robust banking systems, instant payment infrastructures available 24/7. So, in these environments, the official benefits often sound, well, frankly, a bit vague and uncompelling, especially given the prolonged economic stagnation many of them face. So I have to ask, what is the underlying, maybe less stated agenda here?
Well, the stated narrative usually focuses on things like combating money laundering, improving payment speeds, maybe easing government disbursement of subsidies like universal basic income, things like that.
The efficiency arguments.
The efficiency arguments. But when you actually dig into the technical papers and the policy discussions, a secondary and, frankly, far more concerning narrative emerges. And that's the idea that CBDC can be used for deep, granular social engineering.
Okay.
This includes the potential to fine-tune monetary policy instantly, perhaps impose very specific taxes like a carbon tax directly tied to your spending patterns, or even integrate with sophisticated social credit systems.
Okay, here's where it gets really interesting.
Yeah, because the mechanism that enables that kind of control is the twin demand for transparency and programmability. Explain those. Okay, so for CBDC to achieve those crime deterrence and social tuning goals its proponents whisper about, the transactions must be centrally monitorable. They need to be analyzed in real time by the issuer, the central bank.
Constant surveillance.
Essentially. And the currency itself must be mutable, meaning the authority, the issuer, must have the power to seize funds, freeze accounts, or even condition the use of the funds based on certain rules.
So economic freedom isn't a given anymore. It becomes conditional. Conditional on your compliance with whatever the current policy is.
Precisely. It's permission-based spending. And if we look at, say, the European Commission's 2023 digital euro proposal, this paradox is laid bare. They pay lip service to fundamental rights, but they explicitly state the digital euro will not offer the full anonymity of physical cash.
So privacy is negotiable.
It's explicitly conditional and subject to regulatory thresholds. You get some privacy for small amounts, maybe, but beyond that, it's gone.
And the dangers of this kind of conditional authority are not just theoretical, are they? Our sources cite a pretty chilling real-world example.
They do. The Canadian government during the COVID-19 trucker protests, under the Public Health Emergency Declaration, authorities froze the bank accounts of protesters and even donors without needing a prior court order.
Wow.
Now imagine if every single transaction you make is monitored and the currency itself is programmable. Say, limiting your ability to purchase specific goods or services the government disapproves of, maybe restricting high-sugar foods or capping your fuel consumption or preventing donations to certain groups.
It establishes a total surveillance society. Personal and economic freedoms are just structurally undermined. It's baked into the system.
The state essentially gains veto power over your individual economic choices. And history shows, once you lose economic freedom, the ability to resist political or social control diminishes very, very rapidly.
Which brings us to the two possible scenarios our sources predict regarding how CBDC might actually be deployed.
Right. The first one they call Scenario 1, retail CBDC as Digital Panopticon.
Okay, the surveillance state model.
Exactly. In this scenario, the central banks introduce CBDC, but crucially, they leave the underlying fractional reserve banking system completely untouched. So CBDC just circulates in parallel with physical cash and existing bank deposits.
So nothing fundamentally changes in money creation.
Not initially. The authorities simply wait for physical cash usage to decline naturally, which, let's face it, is already an ongoing global trend. As CBDC becomes the chief means of payment for most people, the government then gradually enforces the programmability features.
And what does that actually look like on the street for the average person?
It means the currency degrades into, essentially, vouchers. It's no longer money in the traditional neutral sense. It's a permission slip from the state.
Right.
The government can impose restrictions, what you can purchase, where you can purchase it, perhaps even when. It gives the state incredibly granular control over what you eat, what media you consume, what associations you support financially. That is the digital panopticon realized through the monetary system.
Chilling. But the other scenario is quite different. It's one of kind of internal combustion, a self-destructive path for the existing banking establishment itself.
Yeah, they call this Scenario 2. Retail CBDC as self-destructive future. So imagine a really serious financial crisis hits a major liquidity crunch like 2008, but maybe worse.
Okay.
Users, knowing that the CBDC represents a direct liability of the central bank itself, realize it's inherently safer than a demand deposit in a commercial bank, which is, after all, just the commercial bank's debt to them.
Right. Commercial banks can fail. Central banks generally don't.
Exactly. So this triggers massive digital bank runs. Users frantically convert their potentially risky demand deposits into the safer retail CBDCs instantly online. This kind of run is exponentially faster and more contagious than the classic bank runs of the 1930s where people lined up outside the building.
A digital tsunami hitting the banking system. How do central banks possibly respond to that kind of panic?
They are forced to intervene to stabilize the system. They'd likely have to cap the amount users can convert from bank deposits to CBDC, and they'd almost certainly require immediate, mandatory, verified identity linkage to all CBDC accounts to manage the chaos.
Okay, so everyone using CBDC is now fully identified, no anonymity left at all.
Pretty much. And at this point, the public criticism fundamentally shifts. People start asking, wait a minute, why did we allow private banks to create 99% of the money supply out of thin air in the first place, leading to this very instability? The curtain gets pulled back.
And that public demand for accountability for answers forces the central bank's hands, presumably.
Precisely. They would likely be driven by political pressure to enforce 100% reserve ratios on commercial banks. Now, this is actually a critical potential reform. It would eliminate the structural instability caused by fractional reserve lending and close that second faucet of private money creation.
Okay, so that's a positive outcome in a way.
It is, but money still needs to be supplied somehow. Even with 100% reserves, the central bank would still likely issue its base money against government debt. And that government debt requires continuous interest payments, which in turn must be funded by existing tax revenues.
So the public, having just witnessed this systemic failure, the instability, and the enforcement of mandatory identity for CBDC, asks the next perfectly rational question.
Which is?
If the government is going to ultimately back and control the money supply anyway, why don't they just issue debt-free, non-interest-bearing digital currency directly to the public? Why do we need this complex, interest-funded intermediary structure with the central bank lending against government debt?
And that is the logical path that leads directly to the proposal for electronic public money, or EPM. So the conclusion drawn by our sources here is pretty stark. Central banks in developed nations are rushing to introduce CBDC, even though its benefits for us are often vague, to basically secure central control before the public fully grasps the systemic instability of the current debt money system and starts demanding a nationalized non-debt solution like EPM.
So CBDC is an attempt to upgrade the payment rails without fixing the fundamental debt problem underneath.
You got it. It patches the surface but leaves the rotten foundation.
Okay, so if CBDC is the potential mechanism for centralized control and continued dependence on debt-based money, EPM electronic public money is positioned as the technological answer to both that financial instability and the loss of privacy. It's designed to be electronic cash issued by a new entity, a public money administration, or PMA, with privacy and freedom as like non-negotiable defaults.
That's the goal. Let's first look at the monetary system requirements, which directly address the instability of debt money we just talked about. The first one is the supply adjustment rate. Since the PMA would be the sole issuer of this new debt-free money, it needs a mechanism to regulate the total supply to ensure microeconomic stability, specifically price stability, keeping inflation in check.
Right. So if inflation starts to spike, the PMA raises this adjustment rate, which effectively withdraws EPM from circulation, contracting the money supply transparently.
Exactly. It puts the accountability for monetary stability squarely on the public administrator, not dispersed unpredictably across the private banking sector, creating credit.
Makes sense. What's the second requirement?
The second is the uniform tax rate. This is critical. The EPM protocol itself is designed from the ground up to accommodate a single, automatic, fully flat tax levied on all transactions. It's collected as a kind of public service fee right at the source of payment.
Wow. Okay. So the money reform and the tax reform are intrinsically linked. The money itself contains the tax mechanism.
They have to be for this to work. And third, arguably the most important for individual liberty, is the non-negotiable requirement for privacy protection. EPM must aim to mimic the anonymity of physical cash as closely as possible, while still meeting necessary objectives like anti-money laundering and countering the financing of terrorism, AML-CFT.
That sounds like a contradiction. How do you have cash-like anonymity and AML-CFT compliance?
Well, this is where the proposed design gets pretty clever, I think. They suggest a tiered approach based on transaction volume.
Okay.
So for fully anonymous, low-volume transactions, your everyday stuff, coffee, groceries, there's an upper limit set. Below that limit, you get guaranteed privacy at the system level. No tracking.
Okay, that covers most daily payments. What about larger amounts?
For high-volume transactions, maybe above a certain threshold, you'd only maintain partial anonymity. Now, what that means is identity disclosure would only be possible for legitimate law enforcement purposes through strict due process, specifically needing a court-ordered warrant as part of a criminal investigation.
So it flips the CBDC model. Instead of surveillance by default, you get privacy by default, where surveillance is the rare, legally justified exception, not the rule.
Exactly. That's the core principle.
Okay, let's shift gears slightly to the payment system requirements. Because if EPM is going to potentially replace our current system, it has to be absolutely rock solid, right? It needs to function like critical national infrastructure.
Oh, absolutely. Non-negotiable. So, 4, low transaction latency is essential. Payments have to finalize instantly, within seconds, to be practical for everyday use.
Can't be waiting minutes for a payment to clear.
No way. Then 5, scalability and availability. The system has to handle massive peak volumes. We're talking potentially tens of thousands of transactions per second during busy periods. And it has to be incredibly resilient. Think protection against everything from earthquakes and power outages to coordinated cyber attacks, maybe even solar flares impacting infrastructure.
Wow. And presumably, sector security has to be future-proof.
Absolutely. Quantum computing is looming on the horizon, and it threatens to break most current cryptography. So EPM must be built with quantum resistance baked in from the start. Plus, you need secure storage solutions for users, and potentially the use of advanced authentication methods like biometrics to prevent theft or accidental loss.
Okay, now you mentioned privacy earlier. Let's dive into the central technical argument for how EPM achieves that privacy. You said it must be token-based money, not account-based money.
Yes, this is probably the single most important technical distinction, according to the sources.
Okay, let's take a moment and really unpack that. Most digital money we use today, bank accounts, payment apps, and proposed CBDCs, is account-based. My balance is tied directly to my identity, and every transaction is basically a ledger entry linked to my name or account number. How does token-based money fundamentally differ?
Right. Account-based money, like that CBDC or your bank deposit, tracks your identity, who you are, and what your balance is. The administrator, the bank, or central bank can see all the movements associated with that identity. Token-based money, in contrast, is about transferring the ownership of a distinct digital payment object. It functions much more like handing over a physical banknote or a coin.
Okay, like when I hand you a $10 bill, you don't need to know who owned it before me or my bank balance. You just care if the bill itself is genuine.
Exactly. That's the perfect analogy. The token-based EPM system primarily verifies the authenticity and integrity of the digital token being transferred. It asks, is this token real? Has it already been spent somewhere else? The double spend check.
And if the answer is yes, it's real, and no, it hasn't been double spent.
Then the transfer is authorized and finalized. The system doesn't need to link the transaction itself to the identity of the sender or the receiver to validate it. This is what enables that privacy by default.
Okay, that makes sense technically. But how is that unconditional privacy protected against, say, a future government that decides it really wants to monitor everything after all? Could they just change the rules?
That's where the system architecture comes in. Specifically, its proposed decentralization, which is illustrated in the source materials diagrams, like figure 13.2. The Public Money Administration, the PMA, doesn't run the whole show by itself.
Yeah.
It acts as only one participating node in the overall payment network. Transaction validation isn't done solely by the PMA. It's performed jointly with various private sector participants. Think commercial banks, payment service providers, specialized technology firms, all operating nodes.
So it's a distributed consensus mechanism, kind of like some blockchains. The PMA can't just dictate things unilaterally.
Precisely. So if the PMA, under political pressure, suddenly issued an internal order to, say, seize all EPM funds associated with a certain disfavored political movement,
They couldn't just flip a switch and do it.
they physically could not. The joint validation process makes it technically impossible for the PMA alone to unilaterally change core system configurations, trace transactions beyond those court-ordered parameters we discussed, or unilaterally freeze accounts. The system is designed architecturally as a power-neutral public infrastructure intended to enforce the rule of law rather than the arbitrary discretion of the state.
Okay, that technical safeguard sounds like the crucial firewall for maintaining economic liberty in this digital world. Now, in terms of just using it day to day, EPM needs to feel as easy as, tapping my phone with current apps.
Absolutely. Usability is key. The sources describe an EPM wallet offering a standard network mode for online or remote transfers, but also, crucially, a proximity mode.
Proximity mode.
Yeah, which our sources actually call cash drop. It would use near-field communication, NFC technology, the same stuff used in contactless payments now. This allows true peer-to-peer exchange just by tapping or holding devices near each other. It replicates the physical exchange of coins or notes offline, potentially.
like handing someone digital cash directly, phone to phone.
Exactly. Plus, it would support QR codes for payments and have APIs for seamless integration with existing bank transfers if needed.
And, it's kind of surprising, but the sources mentioned that the required legal shift to enact something like this in a country like Japan might actually be minimal.
Yeah, it's quite ironic. They suggest just a minor amendment to their existing Act on Currency Unit and Issuance of Coins, basically just adding electronic money, variable denomination, to the list of legally recognized forms of currency alongside physical coins.
So the legal hurdle seems tiny, but the structural and political revolution required to actually implement EPM and displace the current system, well, that's immense.
Absolutely massive, which leads us directly to the other half of this revolution.
Right. The EPM proposal, as radical as it is, feels kind of incomplete without its essential companion piece. The Uniform Tax System, or UTS. Our current tax system, income tax, consumption tax like VAT or GST, property taxes, it's really just a fragmented historical accident, isn't it? Often tracing its roots back to funding wars.
It's not just messy, it's become economically harmful, especially in the modern globalized world. Since, say, the 1980s, globalization allowed capital, intellectual property, and corporate profits to move almost instantly across borders.
Right. Chasing the lowest tax rate.
Exactly. This led to intense international tax competition, often called a race to the bottom, where nations kept slashing corporate taxes to try and attract or retain investment. The result, the corporate tax base eroded rapidly in many developed countries.
Which means the overall tax burden inevitably shifted onto things that couldn't easily move offshore, namely labor income and consumption.
Precisely. And all the attempts by governments to plug the leaks, introducing incredibly complex rules around deductions, exemptions, transfer pricing regulations like the OECD's BPS project, base erosion and profit shifting, they mostly just created massive compliance costs, fueled huge bureaucracies, and critically destroyed public trust because the system feels rigged and unfair.
Okay, so that's the problem. How does the Uniform Tax System, UTS, introduced alongside EPM, propose to solve all of this complexity and unfairness? You said it unifies basically all national taxes into one simple fee.
Yeah, that's the core idea.
So let's get down to the mechanics. How does a single fully flat rate, the uniform tax rate, or UTR, actually replace the mind-bending complexity of income tax, corporate tax, and consumption taxes?
Okay, the UTS applies this single UTR automatically and crucially universally. It is assessed and collected instantly whenever EPM is used in any kind of payment transaction.
Any transaction. You don't just mean when I buy coffee or pay rent.
No, we mean every economic exchange involving EPM. Paying a salary, settling an invoice for a service, transferring capital between investment accounts, buying stocks or bonds, even giving a monetary gift to a family member. If EPM moves, the tax applies.
Wow. So the tax base isn't income or profit or even consumption per se. It's the transaction volume itself, the flow of money.
Exactly. The total economic activity conducted using EPM, so using the example from the source. If Bob receives a $5,000 salary payment in EPM, the UTR is assessed on that $5,000 and collected automatically by the system at the source of the payment before Bob even receives the net amount.
So the government gets its revenue instantly, no delay.
Instantly. The transaction is complete, tax included. And this fundamentally eliminates the need for individuals or corporations to file tax returns, calculate deductions, worry about depreciation schedules, or track profits for national tax purposes. All that disappears.
The complexity just evaporates. But
yeah.
Okay, the immediate concern I know listeners will have is fairness. A flat tax rate is almost always seen as regressive, hitting lower-income people harder proportionally. How does the UTS proposal achieve what the sources call the principle of equitable distribution? It sounds counterintuitive.
It does sound counterintuitive, but the argument is mathematically sound when you consider the tax base. UTS is based on total economic activity measured by total expenditures or transactions. So the tax burden gets distributed universally, but it's proportional to the amount of money transacted.
Okay.
Now, while the rate is flat, the base it applies to is universal. It hits all entities, individuals, giant corporations, nonprofits, and it applies to all types of transactions, whether they're for real-world goods and services or purely financial transactions.
Okay, walk us through the vertical fairness argument again for the individual listener. How is it not regressive?
Okay, think about it this way. A low-income earner uses most, maybe all, of their money on essential transactions, rent, food, utilities, basic transport. They transact a certain total amount over the year, let's call that volume X.
Right.
A high net worth individual or a large corporation, however, conducts an exponentially higher volume of total transactions. Yes, they have their daily living expenses, but they also engage in massive investments, buying and selling assets, transferring capital internationally, financial hedging, mergers, acquisitions. Their total transaction volume might be 100x, then 1000x, or even more.
Okay, their total churn of money is vastly higher.
Exactly. So because these high net worth individuals and large corporations conduct such a disproportionately massive share of the total economic transactions in the country, applying that single flat UTR to their vastly larger transaction base means their total tax contribution, their absolute tax burden in dollars, ends up being vertically progressive. Even though the rate itself is proportional, the base is so much larger for the wealthy and corporations that they pay overwhelmingly more in total tax. It automatically self-adjusts based on economic activity or spending power.
So the argument is the more economic power you wield, measured by transactions, the more you contribute, even at a flat rate.
That's the core logic. And this also fundamentally reframes how we think about government financing itself.
Oh, so?
Well, it shifts away from viewing taxes as some kind of penalty on success, like income tax, or a tax on profit, corporate tax, and reframes it simply as a public service fee.
A fee for what?
Essentially, a fee for providing and maintaining the stable, secure national infrastructure, the EPM payment system itself, the legal system, defense, etc., that underpins and facilitates all economic life in the country. It becomes a usage fee for the economic commons. Some call it a cash flow tax or an economic activity tax.
Okay, now let's tackle the numbers, because this is where the proposal moves from maybe theoretically interesting to potentially astonishing. The initial estimates provided for the uniform tax rate required to fully fund the government in a developed economy like Japan they seem radically low.
They do seem low at first glance. To determine the required UTR, you have to estimate the total taxable base, which is the total annual transaction volume expected to occur using EPM. Our sources provide two ballpark estimates based on different ways of measuring that base for Japan's annual government expenditure, which is roughly 100 trillion yen, or about $1 trillion, give or take.
Okay, let's start with a narrow estimate first. What does that include?
Okay, estimate 1, narrow base. This calculation only includes retail-level and interbank payment transactions, so it uses the existing Zengen system interbank transfer volume, plus an estimate for the volume of current cash payments that would shift to EPM. That totals about 3,050 trillion yen annually.
So roughly 30 times the government spending needs.
Right. So to cover the 100 trillion yen in required government expenditure from that base, the required UTR is estimated at just 3.3%.
Wow. Okay, stop there. Think about that. A single flat 3.3% rate on all those transactions would replace all current national taxes, income tax, corporate tax, the national consumption tax.
Everything.
That 3.3% is already drastically lower than just the current 10% national consumption tax in Japan, let alone adding in income taxes, which could be 40, 50% or more at higher brackets, plus corporate taxes.
Exactly. It's a massive reduction in the visible tax rate.
Okay, but the broad-based estimate is the one that really challenges our perception of what taxation could even look like.
Yeah, estimate 2, broad base. This estimate uses the full settlement volume recorded by the Bank of Japan's real-time gross settlement system, the BOJnet. Now, this base includes all the huge wholesale financial transactions, massive foreign exchange deals, high-frequency stock trading, enormous securities and bond settlements, all the big money flows.
Okay, so a vastly larger pool of transactions.
Astronomical. This total volume is estimated at around 54,750 trillion yen per year. It dwarfs the retail transaction volume.
Good grief.
So if you apply the same 100 trillion yen government expenditure target to this enormous base, the required UTR absolutely collapses. It comes out to approximately 0.183%.
0.183%, less than 1/5 of 1%.
That's the calculation.
A rate that is 55 times smaller than the existing 10% national consumption tax alone. Okay, I have to challenge this again, harder. A rate that low, especially applied to high-volume financial transactions. Wouldn't that cause massive immediate liquidity freezes? Wouldn't all wholesale trading, all high-frequency trading, simply flee offshore instantly to avoid even that tiny fractional rate? Why would they pay it if they can avoid it?
That's absolutely the critical question, and the sources address it directly. Their argument is that because the rate is so incredibly marginal, again, less than 1/5 of 1%, it primarily impacts only the most marginal, shortest-term speculative activities. Think high-frequency trading, HFT, where profits are made on minuscule price differences in microseconds.
So it acts like a tiny friction cost.
Exactly. It's actually akin to the original stated goals of something like a Tobin tax, which was proposed decades ago to slightly discourage excessive, purely speculative short-term currency trading. For most beneficial, longer-term economic activities, normal investing, capital expenditure, international trade, hedging risk, the transaction cost imposed by a 0.183% fee is arguably negligible, especially when you compare it to the enormous costs businesses currently incur just for tax compliance, dealing with complex regulations, hiring accountants and lawyers. Those costs often run into the billions for major multinational firms.
So the argument is the net cost of doing business might actually decrease because you eliminate all the complexity, even with this tiny transaction fee.
That's the argument. By eliminating the need for complex tax avoidance structures and compliance departments, the overall efficiency gain could outweigh the tiny transaction cost for most legitimate economic activity.
Okay, it's a radical idea.
Yeah.
Let's quickly summarize the other transformative benefits the sources claim for the UTS beyond just the potentially low rate.
Right. First and foremost, obviously, simplicity. Automatic real-time collection at source completely eliminates the staggering burden of tax filing, compliance costs, administrative labor, and the need for tax accountants and auditors for both individuals and corporations. Think of the productivity gain.
Huge.
Second, neutrality. By applying the exact same proportional burden to all types of payments and all entities, it doesn't distort economic decisions. It doesn't bias against saving versus consumption, or favor debt over equity, or subsidize specific industries through loopholes. This should, theoretically, maximize overall market efficiency.
Let the market allocate resources without tax interference.
Essentially. Third, clarity. It's arguably the clearest, most transparent form of taxation imaginable. One rate applied universally. This eliminates the endless, complex legal arguments over deductions, exemptions, and accounting standards, which should rapidly rebuild public trust in the fairness of the system.
And finally, the international implications. This has been the Achilles heel of tax systems for decades. How does UTS claim to solve the problem of international tax evasion and base erosion that has plagued the G20 and OECD for so long?
Yeah, this is perhaps the most elegant structural benefit claimed. The UTS achieves international consistency almost automatically because the tax is applied to all transactions conducted in that specific national EPM currency, regardless of the geographic location of the payer or the payee.
So if a multinational corporation operating in Japan pays a supplier in, say, Singapore, using Japanese EPM,
the UTS rate is automatically deducted from that EPM payment by the system itself. It doesn't matter where the supplier is.
So multinationals and wealthy individuals can't use offshore tax shelters or complex structures in tax havens to avoid the tax, unless they manage to transact entirely outside the national EPM system altogether.
Exactly. Which would mean either resorting to using heavy stacks of physical cash for massive international deals, which is totally impractical and risky,
Right.
or deliberately choosing to use another nation's potentially less efficient or less stable currency for their primary business, which might carry its own significant costs and risks.
So it effectively neutralizes most current forms of international tax avoidance related to profit shifting and transfer pricing without needing complex global agreements like BEPS.
That's the claim, because the tax base is captured automatically, technologically, at the very moment of payment within the currency system itself. It fundamentally incentivizes other nations to adopt a similar UTS system simply for competitive fairness and to capture their own share of economic activity. You wouldn't need a supranational tax authority. #tagoutro. So, okay, to try and synthesize this really comprehensive body of work we've been discussing, we've basically seen two fundamentally different potential trajectories for the future of digital money. On one hand, you have CBDC, which, as designed by many central banks, risks perpetuating the cyclical instability of the debt money system, while simultaneously introducing unprecedented levels of government control and surveillance through things like conditional privacy enforced by account-based tracking.
The Digital Panopticon path.
Right. And on the other hand, you have this EPM proposal. It offers a fundamentally different structure. Non-debt, public-issued, token-based electronic cash that aims to guarantee privacy by default as a core technical feature.
And crucially, it's indivisible from the tax reform.
Absolutely. So what does this all mean for you, the listener?
I think the core message from these sources is that the reform has to be integrated. You probably cannot fully fix the inherent problems of the debt money system without also radically reforming the tax system. And you likely cannot have genuine privacy and efficiency in digital money without adopting something like this token-based, decentralized public cash model. It feels like a stark choice. CBDC, as currently conceived by many, seems to give the government a potential mechanism for total control over the citizen's economic life, monitoring and potentially restricting every transaction.
Whereas EPM, coupled with UTS, aims to give the government an incredibly efficient, simple, and stable mechanism to fund itself, while simultaneously ensuring citizens retain something akin to the fundamental anonymity and economic freedom they currently possess, at least in theory, with physical cash.
The shift to a fully digital economy feels inevitable, doesn't it? It's already happening.
It seems to be. The choice that looms large now for basically every developed nation is whether we passively adopt systems, like many CBDC proposals, that seem inherently designed to maintain a debt-based, centrally monitored model.
Or if citizens start to demand a technologically superior return to the principles of public-issued non-debt money, like EPM, coupled with the radical efficiency and transparency promised by something like the uniform tax system.
The technology for a free and efficient digital currency and tax system, as outlined here, arguably exists or is within reach. The only real remaining question seems to be political will.
Right. So the final provocative thought is this. What catastrophic event, another financial crisis, a major privacy scandal, or perhaps what level of overwhelming public demand will become the necessary tipping point? What finally forces governments around the world to choose the path of privacy and efficiency over the, frankly, intoxicating illusion of total control offered by programmable money?
That is the question.
Something for you to definitely ponder the next time you tap your card or phone for a digital payment. That's all the time we have for this deep dive. We'll see you next time.